In this session, we will introduce the concepts used to communicate financial information and to introduce the financial statements. Financial statements are prepared to communicate information to internal and external users. As you'll recall from your reading in Chapter 1, an example of an internal user would be a manager, and an example of an external user might be a banker or a potential investor. There are four major financial statements that are used to communicate financial information from a company. And we're going to have a look at an example of each of these financial statements and use them to introduce the terms and the concepts that will be used throughout the course. The first financial statement is an income statement. And the income statement is used to report the profit that the company has made for a certain period of time. So when you look at the date of the financial statement, you'll notice that it's for a whole month. So a financial statement can be prepared for a month or a year or even 6 months or 2 months. The purpose of the income statement is to calculate profit for the users. If we look at how profit is calculated, we would take our revenues and we would subtract our expenses. That would give us profit. Now, on the financial statement, we call that profit net income. And you'll see that net income right on the bottom of this financial statement, or this income statement for Finley Interiors. The two other items that are on this income statement, you'll notice by the headings, revenues and operating expenses. With revenues, revenues occur when goods or services are provided to customers. And revenues are recognized or recorded in the company's books when it is earned, not necessarily when it's received. So when we look at these two types of revenues, consulting revenue and rental revenue, you can't assume by looking at the income statement that this money has been received. What it tells you is that they did the work. So they did $3,800 worth of consulting work. When you look at the expense section, you'll see the term operating expenses. Some companies will just use the word expenses. Expenses are basically costs that are incurred as a result of producing those revenues. So examples of expenses would be the telephone, the power, repairs to any equipment, rent, or wages paid to employees. I try to put the formula revenues minus expenses equals net income somewhere on my paper to help me remember the parts of the income statement. Owner's equity represents the book value of the assets that belong to the owner of the company. The purpose of the statement of owner's equity is to show how that book value changes in a specific period of time. So when you look at the heading for this statement of owner's equity, you'll notice that it's talking about a 1 month period of time. So it's going to explain how the value of that company has changed from the beginning of January to the end of January. The book value increases when an owner invests money or assets in the company and when the company has a net income. The book value decreases when the owner takes money out of the company, and that's called a withdrawal, or the company experiences a net loss. And net loss happens when the expenses are more than the revenues. When you have a look at the example for Finley Interiors, you'll notice that the capital at the beginning of the period, the book value of those assets that belong to the owner, is 0. And that happens when the business didn't exist in the prior month. This is a brand new business that started in January. Two things made the value of the company go up: investments by the owner and net income. Remember, net income is revenues minus expenses. When you have revenues that are more than expenses, you've made a profit, and profits make the value of the company go up. We have one thing that makes the value of the company go down, and that's a withdrawal by the owner. Remember, that's when the owner takes money out of the company for personal purposes. The other thing that makes the value of the company go down is a net loss. And of course, you can't have a net income and a net loss in the same period of time. The net income is calculated on the income statement, It's really important that we always prepare that income statement first so we have the information to put on the statement of owner's equity. The way I like to remember the information that goes on the statement of owner's equity is like this. We always start with capital at the beginning of the period. So at the beginning of the month or the beginning of the year. And we always add two things that make the value of the company go up. The first is investments by the owner, and the second is when the company has net income. Then we're going to subtract the two things that make the value of the company go down. The first is the withdrawals by the owner, and the second is when the company has a net loss. So those two things make the value of the company go down. When you do those two calculations, what you end up with is the capital at the end of the period. So what's the book value of that company at the end of the month? The third financial statement is a balance sheet. And the balance sheet reports the financial position of a company at a specific period of time. So when you look at the heading of the balance sheet, you'll notice that it's stated differently than the income statement and statement of owner's equity. This is for a specific point in time, January 31st. So all of the numbers on this balance sheet are only true for that specific date. The financial position of a company is described by listing a company's assets, liabilities, and owner's equity. An asset is something that is owned by the company and helps the company provide a future economic benefit. Examples of assets are cash. That would be the cash that the company has in the bank account. Equipment that it has purchased, furniture, vehicles, buildings, land, supplies, and accounts receivable. Accounts receivable is one you may not be familiar with. We can always abbreviate accounts receivable AR. An accounts receivable basically tells us how much customers owe the company for work that they've done. So if this had accounts receivable of $3,000, what that means is customers of Finley Interiors owe them $3,000 for work that they've already done. The next section on this balance sheet is the liabilities. Liabilities are debts. Examples of debts would be accounts payable, notes payable, mortgages payable. The most common ones are accounts payable and notes payable. An accounts payable occurs when a company purchases something and doesn't pay for it right away. So with accounts payable, we're usually given about 30 days to pay for something that we've purchased. So the $200 represents things that we've purchased but we haven't paid for yet. Notes payable is a note that gets signed usually when we borrow money for something. So a notes payable usually gets paid back over a longer period of time, like a car loan, and there would be interest charged on that note. So when you look at the notes payable, this $6,000 means that we owe somebody or some company $6,000 for money that we borrowed. When you look at the owner's equity section, and it says the owner's name, Carol Finley, the word capital, and the amount, $11,800. That $11,800 represents what the book value of the company is. This section could be called partner's equity, if the company was a partnership, or shareholder's equity, if the company was a corporation. The last financial statement is a statement of cash flows. Basically, this financial statement describes where a company gets its money from and what it spends it on. Since this financial statement is quite complicated to prepare, we discuss it in more detail in another course.